Afternoon, ladies and gents. I'm Cecil. I'm the head options strategist at Your Options Forecast. I'd like to take a quick look at a trade idea that our head technical analyst Richard posted on the trading dashboard. You'll see here Canadian dollar. So let's move into this trade idea. So Richard basically made an analysis of the Canadian dollar currency pair. And it shows the market has made this huge spike up. It's made a correction, and Richard's now expecting the market to correct to the downside. So let's look at this on the futures side. So here's a chart of the futures. What I want you to note immediately is the futures is the opposite. So the futures, Canadian dollar futures, made this huge spike to the downside, made a correction. So it's exactly the opposite as the actual currency pair. So on the futures side then, what Richard is saying is it made a huge down move, it made a correction, and we're now expecting the futures to trade back up in an upwards direction, make a correction to the upside. Okay, so let's look at this from a futures side. You will see the market made a point down here, and that's at the number 1 point, corrected up to number 2, corrected down to number 3. So if the market at this point in time should turn around and trade back up and take out the high at the number 2 point, we will have a new established trend. So let me draw a trend line there. You can draw a trend line from the bottom of this low to the bottom of that low. That will be our new trend. So if the market does turn around and it trades back up towards the number 2 point, takes out the number 2 point, that will establish a new uptrend in the Canadian dollar futures. And that's basically what we're saying is we want to be part of the action should that happen. At the moment, we don't have confirmation of that signal yet. So we need a price bar. Remember, this is a daily chart. We need a price bar that turns around, it takes out the high of the previous bar. So any bar that takes out the high of this bar, or maybe take out the high of this second, the green bar, if it takes out the high of that green bar, that will be a confirmation for us, an early entry signal that Canadian dollar is on its way up. It's targeting the number 2 point, and the moment it breaks through the high at the number 2 point, that is the point in time when our uptrend is established. Then we've got a new uptrend, and we're targeting an upwards move in the Canadian dollar. So just note that it's very important. Wait for a confirmation that the Canadian dollar is indeed turning around and is now moving up before you take a trade like this. Okay, so let's analyze that in my Options Explorer. Give me a moment just to set this up. Okay, here's my Options Explorer. I've loaded the Canadian dollar futures into the Options Explorer. Just note, if you go a little bit up, there's a Canadian dollar April contract, 3 days left. That's yesterday's data. There's only 2 days left to expiry. On the April contract, it's no use trying to implement something on the April contract. So therefore, we move to the May contract. The May contract is for 37 days left to expiry. So on the May contract, let's analyze that. That is Canadian dollar future. So it's quite important here. This is showing all the call options. And we can see that the market has positioned themselves way up here. That's at the strike price of 78, around 78. That's where the market is selling call options. So the market is really scared. They're really selling calls far above the market. If you look at the puts, likewise, the market has sold a lot of puts at the strike price of around 74. Those puts currently are in the money. So the market is quite confident. Look at the number of volume that sold. The market is quite confident that the Canadian dollar is going to move above 74, and that's the reason why they sold these puts. They have not liquidated. They haven't taken these contracts out. Even with this dip in the Canadian dollar, they're still keeping these contracts in the market. So the market is confident. The big players, the big brokerage houses, they are confident that the Canadian dollar will close above 74. So if you look at both together, they position themselves with put options at the price up here, and they're selling call options at the price up there. They're expecting Canadian dollar to move higher. So already we know from the market action that the market's also expecting Canadian dollar to trade up, which is a confirmation for us for our trading strategy. Let's look at the actual strategy to trade that. So especially if you're using a small account, the strategy that I'm going to show you is ideally suited for a small account, so low risk strategy. Here is a bull call spread. Let's implement the bull call spread on the Canadian dollar. Okay, so what you can see here is it's a low risk, low reward trade, so you cannot lose more than $250 on this trade. You can also not make more than $250 in the trade. So the maximum risk is $250. Let's just plot that. Let's plot the $200 risk line. So this trade is saying if the Canadian dollar trades up above 71, we're making money. So then we will make the 250. And if the Canadian dollar trades down, we will be losing money. But look how far down it has to go. Down here, where you see this dotted yellow line, that's a loss of $200. That's very far away. So it's a really low risk trade. Lots of time for you to notice what Canadian dollar is doing. Lots of time to get out of the market. So if it does drop after you gave a signal to move up, there's a lot of time for you to get out of the market. You don't have to eat a $200 loss. You can get out with a much smaller loss on this trade. Okay, so that is the typical trade. You can move this trade slightly up. So if I move this strategy up, you can see it improves the situation. Now the maximum loss is 200, profit is 300. If I move the strategy down, let's move it down and move it down again. Move the strategy down, your loss is now 300, your potential profit is only 200. So we can move the strategy up between strike price, up and down. And let's just analyze that for a moment. Let's start on this position here. So note the strategy, we long a call option at the strike price of 71, and we short a call option at the strike price of 71.5. So if related to this, we're buying at 71, which is right here near the top, and we're selling at 71.5. So what the market really has to do, it has to move above 71.5 for us to make money. So, and we can see if the Canadian dollar would turn around and it does trade up and it targets the number 2 point, it will go above 71.5. Then we will be taking a $250 profit. So 71, 71.5 is that bracket there, where we will be targeting, and an upwards move is going to put us in the money. So what happens if we move the strategy up and down? So if you move the strategy up a strike price, so moving it up reduces our risk to $200, increases our profit to 300, but we now long at 71.5 and short at 72. So what we've in this case done, if we move our position from 71.5 there to 72 there, the market has to move higher up before we'll make the money. But so the same applies. You know, if the market is going to turn around and is going to take out the number 2 point there, then that bracket 71.5, 72, that's a safe bracket. And it's quite fair to say, you know, the Canadian dollar will then move above 72 and stay above 72. Therefore, that strategy that you see here, this strategy it's a valid strategy. So I must say, personally, I prefer this one. The risk is only $200. It's way down, very low risk rate, and I stand to make $300 the moment that Canadian dollar corrects to the upward side. Just for interesting sake, let's move down to strike prices. So if you move this strategy down to strike price, now we're long at 70.5 and we're short at 71. So you're much safer. Where's the long and the short? The long was at 70.5. So now you're in a bracket here between where it's currently trading and 71. So in the moment the Canadian dollar is going to turn around, you're into the profit. You know, it's a very small chance it will drop. But you are sacrificing profitability now. You can only make a maximum of $200 profit, and you can make a loss of $300. So you've slightly increased your risk. As you can see on the right hand side, you've increased your risk, a slight increase in risk by moving the bracket down. So that in the end is up to you. So remember what we want to do. We want to wait for confirmation that Canadian dollar has traded up. It has turned around. So wait for the bar for it to trade up above that point there. And from that point onward, you need to then decide which bracket you want to trade. 71 to 71.5, 75 to 72, or whatever bracket. You can see down here, the lower you make a bracket, the lower the strike prices that you're using, the smaller will be the profit you're making, and the more the potential risk that you're taking. And the higher you make those strike prices, the more profit there is. Let's move this thing back up. So if I move the strategy up, one strike, move it up a second strike. So now I've got the smaller risk, higher reward, but I've got a higher price bracket. So now I'm sitting at the price bracket that's up here. So the moment that we do that, just remember the Canadian dollar has to move much further for us to be able to make money. So our risk is lower, yes, but the Canadian dollar has to make a more extreme move for us to be able to make that money. So use that as a guideline. So when you do have confirmation that Canadian dollar trades up, then it's time to set up the trade. I would set up the 71.572 strike interval. You might move to 72, 72.5 strike interval if the move in Canadian dollar is very high. But that's the most important thing here. Wait for confirmation. First, the moment that you see Canadian dollar taking up a previous high, preferably that high, it's on its way to take out the number 2. That's the entry signal to say, set up the trade. And at that point in time, decide what bracket you're going to use. Remember now down here, we're targeting a 71.572 bracket, which is up there. It's 1, 2 strikes above the price action. So if this price has turned around and it's taking up out the high of this bar, you still need to move 2 strike prices up. Then you're looking at the bracket 72.5, 73. Buy 72.5, sell 73, call. And of course, you may enter more than one contract. It's a very, very low risk trade. You're not taking more than $200 risk. So your margin requirement is only $200. You can easily trade 3 or 4 or 5 of these contracts to increase the total profitability in the trade. So that's a very good trade strategy to use, especially if you've got a small account. So it's very low risk, nice reward. If the confirmation is there, the momentum is behind you, we know Canadian dollar is going to trade up. It's a very good strategy to use to make some money at low risk. Okay guys, thank you for watching. Later on, when this video is posted, there might be a subscribe button down here. If you hit the subscribe button, you will be updated with new videos as we make them available. Thank you for watching. Have a nice day.